Welcome to a session on how to identify a quality bank and avoid the rest. Banking, financial services and insurance, or BFSI as it is called, is the largest sector by market capitalization in India. It accounts for about 37% of the Nifty 50 index. Your portfolio will almost certainly have some stocks from this sector. So, it's important to understand how to select quality stocks from this sector. BFSI has many different industries and it is not possible to cover all of them in one session. But the most important ones, banks and NBFCs or non-banking financial companies, are covered here. Banks and NBFCs are clubbed together because they are very similar to each other. However, there are very different from other companies simply because their raw material and their final product is money. But all money is not the same, though it appears to be so. The difference is its ability to earn interest or returns. Banks and NBFCs add value by enhancing the ability of money to earn higher interest. Higher interest comes with higher risk, and the ability to manage risk is what separates the men from the boys. Simply put, they borrow money, for example from us as deposits in our savings accounts or FDs, and also borrow money from others on which they pay interest at a certain rate and lend it to borrowers, their clients, at a higher rate. The difference is what the bank or NBFC earns, which is called net interest income or NII. They also earn revenue by providing services to their clients, all clubbed as other income. Net interest earned and other income together are called the total income earned by the bank. How does it get the money that it loans out? And why is that important? Like any other company, the first source of funds is the bank or NBFC's equity, which is the money invested in it by its shareholders and the profits plowed back into the business. The rest of the money is raised through borrowing. Banks are permitted to open current and savings account called CASA from customers like you and me. This is an important low-cost source of funds. NBFCs are not permitted to do so. Banks and NBFCs borrow the rest of the money that they require to provide as loans to their customers. Unlike most other companies, banks and NBFCs borrow much more than their equity. This is called leverage. The amount and cost of borrowings depend on several factors like the promoter's credit standing, the nature of the loan product offered, secured versus unsecured, and the customer segment it caters to. For example, leverage for housing NBFCs can be as high as 8 to 9 times and available at a lower cost since housing loans are relatively safer, while the same for microfinance NBFCs who give unsecured loans would be as low as 3 to 4 times and at a higher cost. This limits how much money is available with the banks or NBFCs and the minimum interest they must earn on their loans to be profitable. High leverage is a double-edged sword that works well when things are good, that is, when borrowers repay on time, but cuts the other way around when things are gloomy and borrowers face tough times and default on payments. This is a significant risk when investing in banks and NBFCs. To whom and for what are the loans disbursed is very critical. It is very easy to grow in a lending business simply because everyone needs money or would like to borrow it. The reasons for loans typically includes housing loan, credit card loans, personal loans, vehicle loans, corporate loans, working capital loans, etc. All borrowers are not the same. Their ability and track record in repayment of loans vary, and with that varies the rate of interest that they are likely to be charged. Success depends on identifying reliable borrowers, lending to them profitably, and ensuring low, preferably zero defaults. This defines the underwriting standards of a lending institution and the quality of its loan book. Underwriting standards are the process and the discipline of lending money by doing thorough checks and having the right process for getting the money back with interest. Now, loan default rates may differ from bank to bank depending on the type of loans and customers. Home loans would have a lesser default than unsecured personal loans. Does that mean a pure housing finance lender is better than a microfinance institution? No, not necessarily. That is because unsecured loans earn higher interest than home loans. But all this means that banks and NBFCs have to live with some loans not being paid. That is default. When the principal or the interest on a loan is not paid for 90 days, the loan has to be reported as a gross non-performing asset as per IBR regulations. And to take care of that, they need to make provisions in the book and report the net non-performing assets. The provision made reduces the profit they declare. When they do recover some of these monies, they get added back. And the net NPA tells us how much of the non-performing assets the bank or NBFCs has not yet made a provision for. Ideally, we would prefer the net NPAs to be zero. So, in banks and NBFCs, to arrive at the profit before tax, in addition to the operating expenses, you deduct the provisions made towards non-performing assets. After paying the tax, you get the profit after tax, just like any other company. The most important ratio to look for is return on equity or ROE. ROE is PAT divided by the equity and it reflects the returns the bank or NBFC is able to earn on its shareholders' money. As I said before, a company can be thought of as a system that uses money to generate profits. ROE is a measure of efficiency. A bank or an NBFC that is able to generate consistent return on equity above its cost of capital is most likely to be a good quality bank. How do you know if a bank or an NBFC is investment worthy? Common sense tells us that as investors, we want to own a bank or an NBFC that makes a high ROE while making large total profits consistently. Money Works For Me decision assesses both these key numbers of banks and NBFCs over 10 years, and consistent performers are marked as green, that is very good. Somewhat consistent are marked as orange, and the rest are color coded red, which is risky. You can see both of these numbers on the Money Works For Me 10-year X-ray. ROE higher than 15 is green, 12 to 15 is orange, and less than 12 is red. For net interest income, growth rates higher than 12% are colored green, 8 to 12% are colored orange, and less than 8% are colored red. This helps you understand where the quality rating has come from. There are three other financial parameters over 10 years in addition to the decision rating that helps you understand the bank's quality. They are earnings per share, book value per share, CASA, which is current account saving account, and NIMs, which is net interest margins. Let's see how. How do you know if a bank or an NBFC is growing sustainably? Money is the raw material for a bank because that is what it lends and earns back with interest. Going back to the topic of leverage, which is loan book as a multiple of its equity capital. The higher the equity capital, the higher the bank can scale up its loan book. It can grow its equity capital in two ways. One is through internal sources. Consistently earn good profits, which is reflected in its EPS, and retain them to increase the reserve and increase the equity capital base. Two, external. Borrow money by raising fresh equity capital. The internal way of funding is obviously the most preferred way, but it is not always practical in a growing economy like India, where the need for capital is high. Hence, a bank or an NBFC needs to raise equity capital to grow faster. What needs to be checked here is how frequently the capital is being raised and at what valuation. This is reflected in the book value per share, and its growth over the years will tell you how well a bank is accruing value to its business. CASA, in the case of banks, indicates what share of its deposits is coming from low cost sources, that is current accounts and savings accounts. Higher the CASA, the better. NBFCs do not have access to these deposits. Net interest margin or NIM, when high, stable or increasing along with other ratios, indicates a strong and sustainable performance. You can see these 7 financial parameters in one place and in an easy to understand manner and more on the company pages at Money Works For Me, and get confidence on which bank or NBFC stock deserves your hard-earned money and ignore the rest. There are more things to see about a bank and an NBFC, which is the same as other stocks. For example, recent performance summary, latest financial and quarterly summary, management X-ray, graphs, news, and analyst notes, which help you identify high-quality banks and NBFC stocks and ignore the rest. Once you are confident that you are looking at a high-quality stock, you need to know what price you can pay to acquire it. And that's what you'll see in the next session.